Hello, hello again. So we're covering the theme this time again with the financial health ratios that you can apply to your own business and understand how these ratios are applied and what they mean. So last week we covered the P&L statement and profitability ratios. So being able to understand gross profit, EBITDA percentage over sales, and percentage of net profit or EBIT as well, underlying operating profit also. So we've got a great session coming up. I'm going to cover the structure of the balance sheet, and we're going to cover liquidity today. So liquidity is the ability of a business to meet short-term commitments with the current assets that they have to hand, ideally being able to convert their current assets into cash to satisfy short-term liabilities. So there are three ratios we're going to cover. One is the cash ratio. So looking at the cash in the business from the balance sheet as a current asset and making that as a divisible over the current liabilities. We're going to look at the current ratio, which is total current assets over total current short-term liabilities or short-term or current liabilities. And also we're going to show the acid test, so the quick ratio. So I'll explain a little bit more about what the quick ratio is or the acid test. And then we'll be able to talk a little bit more about the balance sheet. We might be able to touch on gearing as well when we move from liquidity into solvency, which is the understanding as to how the business is geared based on how it's financed, i.e. from equity or from debt, short and long-term liabilities. So this is going out on LinkedIn, Facebook, YouTube, X, and TikTok. So it's across all of those platforms. Please do comment and ask questions because I will see the comments and I do respond to all of them. I just might not see them come up live as I'm talking to you right now. So feel free to like and subscribe to one of those platforms, and let's get cracked on to what a balance sheet could look like. So in order to understand the balance sheet, I like to draw it in two halves. So a lot of balance sheet financial statements, they're drawn in a column. So you'll have current assets, long-term, non-current assets, long-term investments feeding this cash back into the business, fixed assets, you might have some intangibles and other assets. And then straight after going down, you'll have short-term liabilities, long-term liabilities, and then you'll have shareholders' equity all the way down in one statement. Now, I like to draw it in two halves because it shows kind of like a seesaw, knowing that the total assets must be equal or balanced with the shareholders' equity plus the total liabilities of the business. So let's get cracked on, and we'll get into the liquidity ratios as well. So in terms of the assets of the business, you will have, and other balance sheet statements may have different terminology, but in essence, these are the key areas, key details within the balance sheet. So you'll have current assets. Okay. And current assets mean that they're going to be converted into something. They're something that you're able to use very quickly. So you can convert them into cash to finance the business if necessary. So current assets could be cash. They can also be receivables. So money that you're going to be paid from goodwill or a book of business. Receivables, raw materials, in terms of inventory, then work in progress inventory. If, for example, you're a manufacturer, you hold raw materials to convert them into finished goods. You also may have a certain amount of current assets that you use as working inventory. There could be in flight or could be currently being used, or you want to highlight on your balance sheet. And it's important that you do so, depending on who you want to view it, because work in progress inventory, for example, might be very difficult to convert into cash to finance the business. So that's why it's sometimes pulled out as a separate entry. And when we get onto the acid test, we'll see why that's relevant as well. You could have finished goods as well. If you're a product-based business, delivering finished products into the sector that you're in. Then you may have long-term assets. So long-term investments, for example. And then you'll have maybe some fixed assets as well. So you might have machinery, plant and equipment, and also buildings too. So fixed assets. You may have some intangible assets. So you may have some intangible assets that you want to add into the balance sheet and some other assets as well. So sometimes you see other assets that's been allocated and then noted within the notes of the annual report or the report that the business has created. So you could have intangibles as well. And we can just put other. So these would be your total current assets: cash, receivables, raw materials, inventory, work in progress inventory, and finished goods. Okay, so those are the total assets of the business. And on the other side of the balance sheet, you have liabilities and stakeholders' equity. Well, we'll just show this as a dotted line, because normally this is underneath if you see it in a report or a business's accounts. And so you'll have short-term liabilities or current liabilities. And long-term liabilities. So, for example, put it into perspective, credit. So you've got to repeatedly pay short-term credit that you may have leveraged based on some of the financing that you needed in the business. And long-term could be a bank loan, so it's low interest for you to satisfy long-term liabilities. And that's why, for example, we look at solvency as total liabilities over shareholders' equity, debt plus equity as a ratio. But we'll cover liquidity first, and then we'll get onto the gearing of a business as well. So when a business is liquid, it means it has suitable assets that can be converted into cash to satisfy the short-term liabilities, because usually those short-term liabilities are high interest. They're the ones that need to be satisfied first before satisfying long-term liabilities. And if a business is solvent, then it has sufficient equity in the business to satisfy long-term and short-term liabilities. So long-term liabilities, and then we'll get on to the ratios. Okay, and then shareholders' equity. Okay, now that's why I like to draw it as a little seesaw, because that side and that side should balance. So total assets should be equal to liabilities plus shareholders' equity. And that's why it's called a balance sheet, because they should balance. So if we wanted to look at this business and assess its financial health, the current ratios or the liquidity ratios will highlight that it is receiving suitable amount of current assets to satisfy its short-term liabilities. And what that means is it's not taking out too much short-term debt, so much so that they don't have the ready cash or convertible assets into cash to satisfy those short-term liabilities. So they therefore would be a risk in terms of the short-term liabilities. If you're looking at a balance sheet, you look at the current assets within the business, which of those current assets can be converted into cash, and they've got more short-term liabilities than they have in current assets, then it's a risk that they can't satisfy the short-term liabilities, which means that they'll pay interest, which means they might need to convert that into long-term liabilities, which means they're leveraged highly more with debt. And then looking at the shareholders' equity, are they therefore then solvent to satisfy the liabilities within the balance sheet? So that's why it's important that businesses use this as a statement to be able to demonstrate liquidity and also solvency. There are other ratios we can look at when we look at cash flow and P&L when we talk about asset management. But today we're just going to cover liquidity, and I'm just going to cover some of the ratios that you can use on your own balance sheet to do an asset test, current ratio, and a cash ratio. So a cash ratio is simply looking at the cash that's highlighted within the balance sheet and putting that as a divisible over short-term liabilities. So the cash ratio is cash over short-term liabilities. And there is data available, and experts in the sectors that you're in. I'm able to access this data as well, where you can look at industry averages of cash ratios, liquidity ratios, current and quick. It's important to be able to compare yourselves to the wider industry, because short-term current assets are reflective of how you can convert your current assets into, for example, finished goods, which then have an impact on your cash flow and P&L. So if a business is not very liquid, I would question how quickly it can convert its inventory and its assets into the success of the business, into profitable cash flow, but also, are they making suitable profit for them to get enough of that profit into the shareholders' equity, and are they getting enough of that book of business in terms of the receivables that can be converted into cash? So all of these things allow for more questions when you're analysing the different financial statements. So that's the cash ratio. So it's not typical for a business to have 100% of cash that's suitable for all of the short-term liabilities. If they do, great, but then they have a lot of cash in the business, which can be risky in other ways. You know, how they're going to leverage that cash on hand, for example, and why do they have that much cash on hand? If it's more than the short-term liabilities, it can be put into other uses within the business. And so sometimes it can be a ratio of 0.5, for example. But do look at the averages within your sector. You're able to Google liquidity ratios. You'll get financial websites come up. You'll get some really great places like Investopedia that will show you what these ratios mean. So understanding how much cash is on hand to convert into to satisfy short-term liabilities. Now, the current ratio, got this over here. Current ratio is the total current assets. So from here to here. Current ratio to satisfy short-term liabilities. Now, it does give an indication if a business has things like, this is why I mentioned it right at the beginning, if a business has cash, then it's already cash. If it's receivables, then it's convertible into cash, or you can raise finance against receivables, putting the business receivables as a guarantee. You can convert raw materials, perhaps, to a certain degree, if necessary. Now, work in progress inventory, that's something that probably can't be converted into cash to satisfy short-term liabilities. And so that's where the current ratio gives an indication of the current assets within the business to satisfy short-term liabilities. But that's also where the quick ratio or the acid test comes into it as well. So the current ratio is total current assets divided by short-term liabilities. It should be a plus number, okay? And that means that if it was a 0 point number, or there was less assets in the business to satisfy short-term liabilities, then there's a liquidity risk there. So current ratio equals current assets over current liabilities. Okay. Now, what we're going to look at is the acid test. So it's called a quick ratio because it essentially looks at the cash that the business can get quickly to satisfy short-term liabilities. And I've alluded to the quick ratio before as well. So we've covered cash ratio, the current ratio. So if there is, let's say they've got other current assets within the business, let's say perhaps that works out at 0.5. But this one should be 1 point something at least to demonstrate that there is at least a whole of the current assets to satisfy the current liabilities. Cash, you may have half, or you may not have a lot of it. But look at the industry average, but also look at what you're comfortable with in terms of risk and things like that to have cash within your business. Now, the quick ratio, so if tomorrow you had to satisfy these short-term liabilities, could you convert or leverage these things into cash? Yes, because it's cash. Receivables, yes, because you've got a constant flow of business coming in. So you could take into account receivables. Raw materials, could you or could you not? So again, sometimes it could be perceived that you can't convert raw materials into cash, but you could include that in the current assets that could be converted into cash, short-term liabilities, satisfy short-term liabilities. Work in progress inventory, no, because it's work in progress. So you have to discount that. You have to minus that from the current assets to calculate the quick ratio. Finished goods, yes, because you can sell them. So you can convert those into cash. Now, not wanting to complicate how these assets can be converted at what rates and things like that. For example, raw materials, you might not get back what you paid for them. You might not get back their value, their book value, as it says in the balance sheet. Same with finished goods. You might, if you wanted to get rid of them tomorrow, you might not get the book value of the finished goods. But that's what's included in the quick ratio, is the current assets within the business that can be converted into cash quickly to satisfy short-term liabilities. So things like inventory, perhaps raw materials, work in progress inventory, definitely not. So the quick ratio, or the acid test, we'll draw down here. Acid test, or quick. Okay, so that will be current assets minus work in progress inventory. So we'll draw this here. Hopefully you can still see this. minus work in progress over okay. You can see all of that. So what we've established is from looking at the balance sheet, why these areas need to balance, so you can you're able now to assess the current assets to satisfy short-term liabilities. Also looking at the fact that total assets should balance with liabilities and shareholders' equity. That's why it's called a balance sheet. Cash ratio looks at how much cash is available in the business, just cash, to satisfy short-term liabilities. Current ratio is the current assets over current liabilities. And the asset test, or quick ratio, so the current assets that the business needs to get quickly to satisfy short-term liabilities or current liabilities, is the current assets minus work in progress inventory, current assets that can't be converted into cash. And that is liquidity ratios. So you're able to see how liquid a business is, and in terms of the short-term risk to satisfy short-term liabilities. Now we'll talk a bit about gearing, but I'll cover gearing a little bit more tomorrow in the live as well. So gearing is how a business is leveraged or financed. So if, for example, there is as a total of liabilities and shareholders' equity, if there is 40% liabilities and 60% shareholders' equity, then it's 40% leveraged by debt. Now that's important because, well, the calculation is debt over debt plus equity. So it takes the debt, the total debt in the business, over the total debt and equity as a ratio or as a percentage. The reason why that's important is because it highlights the level of risk of financing the business at the rate of debt and at how much the business is leveraged by debt. So when a business has worries with solvency, it means that it doesn't have suitable equity in the business to satisfy liabilities. It might not have suitable current assets to satisfy short-term liabilities, and it might not have sufficient assets or equity in the business to satisfy all liabilities, because using all of the three statements, therefore, if there's no equity to satisfy short and long-term liabilities, if the business isn't making suitable, profitable cash flows to be able to inject into the business and leverage its assets for the growth of the business, and therefore has insufficient current assets to satisfy short-term liabilities, it then has liquidity issues and it could become insolvent. And so if a business ideally is leveraged heavily by debt, more so than equity in some cases, then they need to be able to demonstrate that they have sufficient cash flow and sufficient business and profitable cash flow coming into the business to satisfy these commitments short and long term. So it's a sustainable business model. So if, for example, a business wants to grow, they may go and get some sort of funding, which means that their long-term liabilities will increase more so than their shareholders' equity, perhaps. And therefore, that's why we need to put in place business plans, business cases, forecast predictable future cash flows, demonstrate that the business, with this debt finance, will be able to satisfy short and long-term liabilities with current assets based on receivables, cash, and being able to convert its assets that it has into finished goods or into profitable cash flows. And also going through the profit and loss sheet, how quickly that will then profit after tax land into the firm's profit to therefore make the business more solvent. So when you look at a business's gearing, you're looking how it's financed. When you calculate things like weighted average cost of capital for businesses, you look into the cost of borrowing, you look into the corporate tax rate, and you look at how the business is leveraged by debt over debt plus equity. That will give you an understanding as to the level of risk as the business in terms of debt and liabilities. You then look at the opposite equation, which is equity over debt plus equity, and you look at the cost of equity to the business. That can be done through calculating dividends through a Gordon growth calc, or it can also be look at equity betas and things through capital asset prices model. When you combine the cost of equity and the cost of debt, you get, based on what I've just said, you get the weighted average cost of capital. So that's why gearing is important, because it's quite a fundamental factor taking into account the weighted average cost of capital, because the weighted average cost of capital, or the WACC, is then used as a discount factor to bring your future value back to present value that you've predicted in your business plan. And that therefore totaled using the weighted average cost of capital, discounted back from your forecasted future cash flows into a net present value of future cash flows. And that's essentially using forecasted cash flow, how you can put a value on a business. So gearing is important and liquidity is important, because when you look at them collectively, you can start to think about the value of a company. You can start to think about the level of risk in a business. You can start to think what other people think when they're looking at your balance sheet, with a finance head or from an analyst head or a valuation standpoint as well. So just to recap on the liquidity ratios, because I like these, you can quickly look at a business balance sheet, get familiar with it, and start testing out some of these current ratios. So cash ratio, cash in the business from the balance sheet divided by short-term liabilities. Current ratio, does the business have sufficient current assets as a total number to satisfy short-term liabilities, i.e. is it liquid, can it get ready cash quickly? The quick ratio, if it needed to do it tomorrow, which of the assets, current assets, can be converted into cash quickly, and which more importantly cannot, so therefore they need to be deducted from the current assets and divided by the short-term liabilities. That's why in this example I've taken off the work in progress inventory, because it's work in progress, it can be converted into cash quickly, hence the acid test or the quick ratio. Have some fun. Balance sheet's going to be fun, believe it or not. Have a go with your own balance sheets. Look at some other big businesses, small businesses that have published balance sheets to see and get to grips. Look at some other competitors in your industry and see if you're able to compare how liquid you are compared to other businesses. And it should demonstrate some other ideas around your financial health as to how much risk is in your business. If you've got suitable current assets to satisfy short-term liabilities, then you're showing liquidity in your business and should be a sustainable business model. Enjoy. So we'll cover tomorrow a little bit more on gearing, and I think I'll try and cover some more on the weighted average cost of capital as well, because that's quite a key factor that you're able to, when you work out a business's weighted average cost of capital, you find out so much more of the makeup, and even in terms of the operations, sales, how the brand stands out, quite a lot if you're able to look at weighted average cost of capital. So we'll cover gearing tomorrow and a little bit more about weighted average cost of capital, and then maybe next week we can do some calcs and things like that. Enjoy. I'll see you all tomorrow.